Good morning and welcome to your Friday, April 5th market news update. The non-farm payrolls serves as the main attraction of the day. The Reserve Bank of India kept its policy repo rate intact at its April meeting. Shell, the oil gas giant, reports its Q1 earnings results later today. Loonie traders brace for Canada's latest employment report. Crude captures the $70 per barrel level as geopolitical tensions keep traders bullish. Airbnb's 7-day losing streak could attract dip buyers. Finally, Japanese equities pull back further away from record highs as investors cash out. That's all for now, and thank you for watching.
Hi, everybody, and welcome to another daily presentation. This is the market overview for the 5th of April of 2024, and these are the key events that you should familiarize yourself before starting your own trading day. So it is that day of the month, and we're going to talk about, more specifically, about the incoming inbound NFP print in today's session. So the main attraction of today's session is, without a shadow of a doubt, the latest employment report for the month of March for the United States economy, which will act as a reflection point for traders' outlook in regards to the Fed's monetary policy actions going forward. So in a recent speech this week, we heard Fed Chair Powell not providing any further clues for market participants in regards to the bank's rate outlook going forward, and the gist, in a sense, of the commentary or the gist of his remarks revolved around the need to proceed with caution in regards to monetary policy actions, and has stressed once again the fact that the incoming data is super important for the assessment of the central bank in regards to their plans, and in a sense highlighted the impact for a premature rate cut. And therefore he stated that we need to not go forth in a radical manner and alter the current policy stance if the data does not support it. So a piece of data that will definitely impact how the Fed approaches this kind of scenario, or his, in a sense, its duties, is going to be today's NFP print, and taking a quick peek at what the market expects in regards to the NFP print. We observed polled economists forecasting a slowdown in the job creation mechanism of the United States in the month of March, a slight decline in the pay growth, and a steady unemployment rate hovering close or near and round and about what we call historical lows. Now, more specifically, the headline non-farm payrolls figure is expected to drop to 212,000, lower than the upwardly revised figure of 275,000 that we received last month. Also expect to see an unemployment rate standing still at the 3.9% level, and average hourly earnings easing by 0.2%, down from the 4.3% towards the 4.1% level. Now, should we see the actual rates and figures matching expectations, in a sense, pointing to a slowdown of the job creation mechanism in the United States, that would give market participants a nod of approval and confirm their own biases in terms of impending rate cuts by the Federal Reserve in 2024, but more or less solidify the market consensus views that it is time to start cutting rates. Okay, that in a sense may translate into weakness in regards to the United States dollar in the FX market, and possibly its counterparts taking advantage and capitalize on these kind of shortcomings. We also would expect to see a renewed bout of strength for the precious metal. We're talking about gold here in the commodities market, but more importantly, this data, this depleted kind of data, could serve as another signal for equity traders to carry on with their exuberant buying operations. Now, we have to make the opposite case here. Shall we see an unexpected beat of the NFP print, possibly ranging somewhere north of 300,000 jobs created within the March period? That would push back on the narrative for a rate cut in the June meeting and could dilute further possibilities and probabilities and chances for additional cuts in 2024. Shall we see this kind of robustness from the labor market of the United States coming forth once again, and in a sense, creating a streak of beats in regards to the job creation mechanism that could drive gold's prices to lower ground, further away from the all-time high peak they have reached in the past few sessions, and US stock markets falling quite radically from this kind of level. They have been going on easing, losing their values. In the past week or so, we have seen a sort of a pullback and a stalling near all-time highs. Once again, positive or a strong or an exceptionally strong, much more accurately put, NFP print could drive them to lower ground, in a sense, create a sort of environment that will facilitate kind of a sell-off scenario. Okay. So in regards to money market future probabilities, market participants are currently assigning a 60% chance in the scenario for a 25 basis point rate cut by the Federal Reserve in the June meeting. Remember, this 60% last week was ranging round and about the 70% level. So we see an easing of confidence or a loosening of confidence by market participants that called for a rate cut in the June meeting. A robust NFP print could push this kind of probability to lower ground, possibly driving it lower to the 50% range, and is going to have dire implications, as we just mentioned beforehand. Now, shall we see loosening of the tightness of the labor market? That would, in a sense, translate to higher chances for a rate cut in, in the June meeting for a 25 basis points rate cut, but also we may see more than two cuts, which are currently being priced in, so 3 in total. More than 2 cuts maybe start to sprout. Projections for more rate cuts when we start to sprout, not only in September, December meeting, which is currently what the market expects, but possibly in the October meeting as well. So currently we see the market forecasting 3 rate cuts in 2024, total of 75 basis points. So that leaves, a key terminal rate of 4.75% for the Federal Reserve. If we get a downbeat NFP print, that may turn out to be may see an additional 25 basis points high rate cut entering the picture as well. So for a total of 100 basis points. For the time being, we have to note that the probabilities and the projections by the market kind of tempering. Compare that with probabilities that we got at the start of the year. At the start of the year, we saw 5 rate cuts being projected by money market participants. Now we are in April and we see the market adjusting their projections according to the Fed. Okay, that apparent deviation, that apparent divergence that we observed in the January kind of period, these probabilities have evaporated and we see the market going in line, or aligning with the Federal Reserve and matching their projections. So we might have reached a quote-unquote equilibrium kind of point here. So we will see how the NFP is gonna affect this. So most probably we're going to have an update, a small update and a small recap, a small summary on the Monday's session to note what has happened in today's session. So for the time being, there's not much else to say. So thanks guys for watching. We will catch you on to Monday session for another update. For the time being, have a lovely weekend as well. Take care. Bye-bye.
In this video, we will look at news trading on economic releases. This trading strategy is appealing to many short-term Forex traders. As markets move in response to news, the release of economic data is frequently the most important catalyst for short-term movements. Essentially, this trading strategy involves trading around significant Forex news events, such as key economic releases from the countries whose national currencies consist of the major currency pairs. Because key news releases have a strong influence on currency pricing, a Forex trader can use them to potentially profit from those movements. There are 8 major currencies available for trading, so there is always some economic data available that Forex traders can use to make informed trades. Dozens of economic data are released almost each weekday, excluding holidays, from the 8 major most followed countries. As a result, there are numerous opportunities for traders who prefer to trade news. As the US dollar is on the other side of 90% of all currency trades, US economic releases tend to have the most noticeable impact on Forex markets. If you want to trade news successfully in the Forex market, you must know when reports are expected and which releases are most significant given the current economic conditions. Generally, the most important information relates to changes in interest rates, inflation, and economic growth, retail sales, manufacturing, and industrial production. To sum up, it's important to do your research and stay current on economic news in order to reap the benefits. Thank you for watching.
Hi, everybody, and welcome to another episode of our webinar series. Hope you are all having a lovely Friday. So today the topic will be, again, around technical analysis, and more specifically, we're going to dive into chart patterns. We're going to do the super basic stuff and the most common patterns you can spot out there in financial markets, and how to actually decompose them, okay? Interpret what kind of meaning they are conveying at the end of the day, how to spot them correctly, and then how to trade them correctly as well, okay? So we're going to go over the most widely known ones. We're going to talk about the head and shoulders, for example, pattern. We're going to do a brief intro into the saucer pattern, or in other words, the cap and handle. We're going to visit double tops, double bottoms, triple tops, triple bottoms, all that kind of lovely stuff, flags and pennants, and ascending triangles, descending triangles, symmetrical triangles, all that kind of stuff. We're going to see them into today's session. Again, it's going to be super basic. It's for you guys that have just started out your trading journey. I'm going to give you a brief overview of what patterns you may start to, if you would like, spot out once you give you what kind of templates, what kind of characteristics they need to have in order for them to be valid. Okay. So, without further ado, let's make a start. So this is the risk warning and the disclaimer. You can read that on your own time. For the time being, let's move on. What is the agenda of today's session? So we're going to do a brief introduction into chart patterns. We're going to underscore and outline the most widely known patterns. And then I have personally split into two categories, two broad categories, what we call reversal and continuation patterns. We're going to watch and we're going to go over each and every one of those that fall under any of these two categories, for you to, again, get assimilated with what patterns may arise in the financial markets in general, and again, spot them, identify them correctly, judge whether they're valid or not, and trade them accordingly. Okay, so let's do a small recap before we start. So technical analysis, this is a branch of technical analysis we're going to study today, chart patterns. So let's do a small overview of what technical analysis is. So it's a study, in a sense, of market action through the use of charts in order to forecast future price trends. Again, some may call it a psychological study of behavior of traders within these financial markets. Okay, so market action, in a sense, includes three elements: what we call price, volume, and open interest. And technical analysis can be used at the end of the day in all kind of time frames for each and every instrument you would like. And more specifically, in regards to time frames, you can do technical analysis for short time frame periods, medium term, and longer term kind of again, what would you call it, horizon. Okay, so it applies and can be applied and can be used for any given type of trader out there, whether you are a scalper or a swing trader or a position trader. Any one of these kind of types of traders can benefit from using technical analysis because it can be applied to any given time frame. Okay, so technical analysts develop trading rules and trading system by using various theories, charting tools, and indicators. We have briefly outlined them meaning some charting tools we have done in the past. Okay, and we're gonna as we progress throughout the series, we're gonna introduce technical indicators, and more specifically, which ones are useful under which kind of conditions. Okay, so if a market is trending, you can use moving averages, RSI, moving average, convergence, and divergence. There's a lot of technical indicators that can be used on a trending market. Whatever, if you have an instrument or a market that is trending in a sideways manner or is trading within a close trading range, okay, other technical indicators are more appropriate under those kind of circumstances. Okay, so some examples of technical indicators that can be used on these sideways kind of movements are commodity channel index. You can do McClellan, ADX, possibly. You have a lot of other technical indicators calibrated for each and every kind of type of trend within a market. Okay, so the idea here is to introduce all of them and introduce what are the strengths and weaknesses, and at the end of the day, apply them accordingly depending on the situation. Okay, so at the end of the day, we have let's circle back to technical analysis, the overarching theme of this kind of presentation as well, and many others throughout the series. As technical analysis and technical analysis in general has three main principles, if you would like, and more, but we decided to place on this slide the most widely known ones, or at least the ones that most agree are the key components. Okay, So there are three quote unquote truths in regards to technical analysis, again, quote unquote. That market discounts everything, and any sort of new information coming in is already at that point in time being implemented into the price action. So markets are being moved by incoming data, and once incoming data rolls in, the market adjusts itself accordingly. Now, the other aspect is that the key principle is that price moves in trends. Okay, hence, if you assume that from the beginning, that means there is an inherent predictability in regards to market trends, and you can actually capitalize upon that. And the last one is that history tends to repeat itself. So points in time in history when you have specific uh, underlying factors, okay, directing a price move towards an undefined kind of goal, okay, and or end or direction, okay. If those same parameters or same underlying components arise in a different point in time, you can, in a sense, once again, expect the market to react in a much similar manner. So, for example, we're talking about a simple example might be a central bank embarking on an aggressive tightening campaign since inflation in that economy has run rogue, if you would like, or has exceeded the bank's target. You would reasonably expect to see the reaction from central banks, which, if inflation is high, they will follow up with interest rate hikes, which we have discussed in the prior webinar, that once you start seeing a central bank raising rates in order to squash inflation, you get specific kind of movements in markets. For example, you will see, reasonably speaking, an appreciation of that country's currency, okay, more inflows towards that specific currency, mainly to take advantage, mainly because international investors take advantage of that high interest rate kind of level within that country and get, in a sense, paid interest because they will deposit money into that denominated that country's kind of denominated accounts, if you will like. And you also get similar reactions or opposite reactions in that kind of case in regards to stock markets, since you have uh, a bottleneck of funds flowing from central banks towards businesses and banks and then businesses. Okay, that tends to lead to a loss or slowing down of consumption trends. Okay, or at least access to funds is much more hard. Thus, in a sense, stifles economic activity, and therefore you don't have the same opportunities in the, for example, equities market. Thus, you can have a negative reaction in stock markets. So it's a different plethora of different indicators and different components that affect markets in general. So once you see a bundle of these kind of underlying circumstances arising at, for example, this point in time, and you go back in time and see what kind of other periods have had the same kind of underlying parameters, and you see the reactions, you can extrapolate from that and capitalize upon that. That's, in a sense, the point about the history tends to repeat itself. Okay. So again, inherent predictability is used for profit-making opportunities. Okay. So let's move on to the most widely known patterns. Okay, which is the main concern of our webinar series, webinar episode today. Okay, so chart patterns, let's make a start with the most widely known ones. Okay, so the prime example for a cap and handle formation is what is one of the most widely known ones, the most symbolic or the most recognizable one by traders, because mainly because it's super simple to spot. Okay, and it has specific kind of components or parameters that need to be fulfilled in order for it to be a valid cap and handle formation. So cap and handle formation, also called the cap with the handle, same thing, is a bullish chart pattern that is defined by a chart where you have an instrument's price which drops in value. Hopefully you can see my mouse pointer. Okay, we're talking about the left hand side of the so-called cup, okay? Price drops in value, then rises back up to the original point in time. Let me get my pen, whatever that is, much more nicely. Okay, so the initial reaction is a sharp fall of prices. You get some sort of base here, okay, or a consolidation area if you would like, okay, and then is followed up by a sharp rise of prices at the same level as the one that has fallen in the past, okay, which created this kind of cup. And you get from there another drop, not as harsh as the first one. Again, some sort of consolidation, a rebound, and then what we say when we call in financial markets a technical breakout from that same level that we saw prices falling initially, second level where we saw prices stalling at. Once you see the break above that is, in a sense, the complete formation of what we call a cap and handle. Let's look into the characteristics. However, in order for us to keep that on the back of our minds, and when we see a cap and handle formation, spot it correctly firstly, and then validate by checking the boxes whether this is actually a cap and handle formation. So important characteristics of this pattern is that a cap and handle formation should follow an increase in trend, ideally one that is only a few months old. We're talking about this level here. Okay, so the older the increase, the trend, the less likely that the cap and handle will be an accurate indicator. Now, the shape, in regards to a shape, a cap and handle formation, the cap must always precede, okay, the handle, okay? You can't have a cap and handle formation like this. This is not a cap and handle formation, okay? So a valid cap and handle formation, okay? The cap must always come before the handle, okay? So not the other way around. That's a first, okay? That's the first parameter that you should pay attention to. Now, the cap should form, let me get this out of the way. Yeah, a cap should form a rounded bowl shape. So we're talking about this here, okay? So it has to have a bottom, which indicates a strong consolidation, okay? A fight between the bulls and the bears is not leading to anywhere, so, okay? Remember the analogy we had with the tug of war in prior webinars where we have the bulls fighting with the bears, pulling this kind of rope, okay? But the price action is not going anywhere. No one of the two is gaining advantage, if you like. So therefore, you get a stalling of price action or the formation of a trading range, what we call. So a sideways price action kind of thing. In this kind of case, we call it a consolidation. Okay. So the bottom of the bowl is the consolidation area after the sharp fall. Okay. And then from there on, you see the price action rising sharply afterwards, okay, forming completely what we call a cup. Okay, that's stage number one. Something else to remember is that the cup should be a cup and not a V-shaped kind of formation. V-shaped kind of formations, obviously, by looking at them, they broadcast some sort of volatility. So falling of price action and then jumping right back up is not what we look for here. We need to have some sort of area of consolidation, that fight between the two, because this might be just, again, a volatile kind of reaction and not an actual valid formation of the cup. So something else to keep in mind. So in a sense, the cup should be fairly shallow and ideally should retrace about 30 to 50% of the price increase. Okay. So if you have a movement coming up like this cup shall be about half or 1/3 of the prior move. Okay. So that's something else to keep in mind, this kind of analogy. So the perfect pattern would have equal highs on either side of the cup. So for the price, the level where the price action has fallen from, okay, now acts as a valid resistance level. So the price action should ideally come up to that kind of point and face resistance once again. So nearing that level is the ideal kind of thing, but also have variations. You might have some price action breaking above it or not coming up to that kind of level. Still valid, but not as valid as an ideal cup and handle, which needs to rise to that kind of level for the same, rise to the same level as well and challenge once again and fail. Okay. And the duration of the cup, in a sense, should last for about 1 to 6 months. You can adjust that for lower kind of timeframes as well. This is, remember, this is the written in stone kind of textbook description of a cup and handle formation. You can spot a cup and handle formation on a much shorter time frames. We're not talking about mini charts here. Maybe instead of 1 to 6 months, that could take place, for example, between 4 weeks, or meaning 1 month, and let's just say 2 or 3, okay, or at least 3 weeks and 2 months max, okay. So remember this kind of analogy because it's going to come in handy, okay. So the cup must always take longer to form compared to the handle, okay, something else to keep in mind. So if the duration of the cup has taken between 1 and 6 months to form, the handle shall and should, if it's an actual validated kind of cup and handle formation, should take anywhere between 1 to 4 weeks. Okay, so you get the analogy that this handle must be much shorter in duration compared to the cup. Okay, so in other words, that is not optimal to have a cup and handle like this. Okay, so in a sense, you need some sort of analogy between the two. You need this handle to be much shorter in kind of duration compared to the cup. Okay, so in regards to volume, the volume of the instrument could decrease along with the price during the cup. Okay, and should increase rapidly near the end of the handle, okay, where prices begin to rise, okay. We need to see a rising volume somewhere in this kind of region. Here, you're going to have fall of volume, okay, stagnated volume levels here, rising volume levels here, but most volume, at least the stronger the volume bars or the larger the volume bars should take place in this kind of breakout phase, if you would like, at the candle, at the formation near the candle. Okay, that's the ideal volume profile for a valid cup and handle formation. Okay, so moving on. Before we move on, let's quickly point out that there is an actual cup and handle formation being formed on instrument, on an equity. I found this a few days back. We have been capitalizing upon this. We played this quite a few times. So we're talking about what this company is called Compass Pathways. You can clearly spot cap and handle here, cap formation here, and a handle formation there. Okay, so let's look at it with a little bit more clarity or zoom in a little bit. Does it validate our kind of rules in regards to being a valid cup and handle formation? So let's firstly speak about time and duration. So it took from the 14th of September until January 8th to form. So we're talking about 3 months, okay, for the completion of the cap and handle formation. Let's look at the level that it has fallen from. Okay, so the lips of the cap, if you would like. Okay, so this is the level where it fell from. This is the consolidation area or the bottom of the cup we just mentioned. Okay. Okay, some consolidation has taken place between this kind of range. Okay, then you see the right hand side of the cup, okay, rallying as high as the level that it has fallen from. Okay, so stalling there. Okay, this acts obviously as a resistance, which is going to be turned into support. You're going to see that shortly. But for that point in time, that was the resistance level. We see the pullback or the retracement and the formation of the handle. Okay, how much time did this take? Obviously, less than the 3-month period we just said. So from September to January for the formation of the cup, and it took merely how much? From the 8th of January until the 26th, so 2 weeks, give or take, okay, for the handle to just say materialize. And after that, we see what exactly you normally see after a technical breakout. We see the first challenge of the resistance level failing, the pullback, rise again of the price action sharply with rising volume as well. So volume indicator there, but you can see that from MACD as well. Rise of price action, breaking past of the prior, okay, resistance level, okay, and rallying to new ground, and some area where would you reasonably expect to have some sort of resistance after the breakout would have been that, broke past that, so we have to go further back, okay, so obviously you will have had some sort of pullback there, or at least a stalling there, because this is certainly a valid resistance level. And if you can pull that further back, you can see the price action has rebounded quite sharply from there. Okay. But in the grander scheme of things, this appears to have loads of free room to run, if you would like. So before placing, for example, a long order up at the top, I would have reasonably liked to see some sort of pullback from there. Okay. Wrong tool. Where is the ghost feed? Okay. So something like this. Okay. A retest of this level. Okay. Oh, sorry. A retest of the prior resistance level, which has now, since it was broken, become a support level. If we see a price action falling back towards this kind of level, the approximately $10 level, bounce, finding support there and bouncing once again higher from there, this is definitely a lovely play for going long. So if, for example, something like this happens, is definitely ideal. Okay. So not going beyond that. I have to fix this. Okay. If you get something like this, okay, hopefully let me mark it for you. If we get a retest and then in a sense another higher low, okay, so you can do this to mark this kind of territory. Okay. If you get a higher low, we're using an ascending kind of trend line, and then you see the price action rolling from there, that would be the ultimate, if you would like, entry point for playing correctly this kind of pattern. Okay. So having a target like this, and let's see where we reasonably expect to get some sort of stalling of price action. Certainly the next target is way, way, way far away from us. So if we assume that this is definitely a valid resistance level, obviously you can see that is a pick and we see a rapid falling of prices. You have multiple targets for you to choose from on where you place your take profit from. Okay. Next valid one might be this, which is somewhere where we would have reasonably started to cover at least partially our position and make money on this. So let's see, the risk reward ratio is somewhere around more than 4. So it's definitely nice. So we're risking about 8.5% if the price action falls to the prior support level. Once we get all this kind of movement, we're risking approximately 8.5%, and we are willing to make money, let's just say, and for what, 35%. So that's definitely something very nice in regards to risk reward ratio. Okay, so that may be one play. If you are much more aggressive and much more, I don't know, exuberant in your take profit targets, you can raise it up there, which is 70%. Definitely some eye-catching kind of number, but it's going to obviously take longer than that. We don't know for sure if that's going to um, become a reality or manifest, if you like. If you don't see, for example, prices breaking past this crucial $15 level for over resistance, then no need to have a target up there. So cautious and quote unquote sophisticated kind of take profit level would have been somewhere around the $14.5 level, okay, for this kind of play. So you can see the fact that this cup and handle formation was created, okay, at the bottom, okay, of the market is another strong indication that is a for sure lovely reversal kind of point. So it gives us much more confidence that the price action will rally from there onwards. Okay, so that's one play for you right there, guys, in real time. Okay, so moving back to our slide of the presentation. Yep. Let's discuss some other lovely chart parts informations that are also used for, in a sense, placing a lovely strategic play. So these are double top and what we call double top and double bottoms. Okay, so you have, in a sense, what we call here a McDonald's sign and a Wendy's sign. So Americans and their burger joints. So we call this a double top and double bottom. So the price action rallies to this specific kind of level, pulls back, and then rallies once again, fails to break above it. Okay, price action retraces to lower ground, breaks what we call this kind of neckline, and then surges from there downwards. If this is found on a market top, okay, on a rallying kind of instrument, this is definitely a lovely reversal kind of signal. If this obviously is found on the flip side, if this is found on the bottom, okay, prices are actually falling all the time, and you see this at the market bottom, the price action falls to this kind of level, rebounds from it, falls once again, fails to break below it, and rebounds once again, breaks past the neckline and rallies from it, okay, gives you an indication that it's a valid reversal kind of signal, and you can play this accordingly. Once you see the break above the neckline, you can generate a buy or a long order here. And in this kind of case, once you see the definite breakdown below the neckline, okay, you sell, okay, you generate a short kind of call for this. Obviously, there are variations of the double top and double bottom. We have triple tops and triple bottoms, something like this and something like this. Okay, much more grave in their potency, if you will, like much more important is potency, okay, because you have 3 times that level is not broken in regards to a triple top. That gives you an indication that whenever the price action falls below what we call the neckline, the price action is gonna fall rapidly from there onwards, because you have a wall of sellers there, not allowing the bulls to push the price action to high ground. They fail once, they fail twice, they fail thrice, and when the break below the neckline appears, sell signal is generated. Flip side, again, triple top and triple bottom. So in the triple bottom kind of case, bears are in control, the pushing price action to lower ground. The bulls are constructing a wall of with their orders down there, not allowing the bears to push the price action to lower ground. Fail once, they fail twice, they fail thrice, break above this kind of neckline by a lot and by a definitive amount of number of percentage, if you would like, creates what we call a buy signal here, and you expect this kind of reversal to take on momentum from there onwards and rise to high ground. Okay, if this is found at the top, it's definitely a lovely reversal signal. Same goes for this, but if this is found on a bottom, this is another valid reversal kind of signal. Okay, so characteristics: found near the end of the bull market, has two consecutive peaks. Prices bounces from the neckline from the second to form the second peak. So we're talking about this. Okay, and when prices fall below the neckline, is considered to be a bearish signal, sell position, etc., etc., etc. We just discussed this. Double bottom, same thing. If double bottom is the end formation in a declining market, yep. So if it's found in the bottom, definitely potent. It's identical to the double top except for the inverse relationship in price. Obviously, the pattern is formed by two price minima or two lows. Yep. Separated by a long peak. Okay. Which kind of defines the neckline. This is the neckline. Most of the rules are associated with the double top formation also apply to the double bottom formation. So a break above this level is a buy signal, strong reversal kind of chart pattern formation. Okay. And volume, we need to show up marked up interest or increase, excuse me, once you start to see prices rallying here at the end of the second bottom. Okay. So here you need to have the confirmation for a rising volume. Okay. Next one is what we call the head and shoulders chart pattern. Okay. We're not talking about the shampoo here. Okay. So you have what we call a left shoulder, imagine a head, and a right shoulder. Okay. So this is one of the most widely recognized chart patterns out there. Traders actually scavenging to find out where these are actually formed. So when you see these being formed at the top, okay, head and shoulders at the top, once again serves as similar kind of has similar implications, much like the double top and triple top. Okay, break below the neckline, which is the connecting line between the two throws. Okay, here, break below here is what generates the sell signal, but it needs to be a substantial kind of move, a clear break below it. Okay, so it consists of, in a sense, three peaks, 1, 2, 3, we just noted. A neckline is drawn connecting the lowest points of the head, and a break through the neckline provides a sell opportunity. Okay, covered this. Opposite case here with the inverted head and shoulders. If this is found on a market bottom, okay, again, serves as a reversal signal. Once again, bullish reversal signal in this kind of case, bearish in regards to this. Okay, so again, left shoulder, head, and right shoulder, these three throws. The head must always be lower than both the shoulders. Something else to keep an eye out. Same thing goes for here. Head must always be higher than the left and right shoulder. We don't really give much attention to the positioning of the right and the left shoulder, comparing them together. Okay, so might be near the same level. Fair enough. Some of them might be slanted, so this one might be higher than this one. Nevertheless, what we pay attention to is the head needs to be higher than both of them, and we need to see the connection of the two throws forming the neckline. A break below the neckline, sell. Opposite is situation here. So the head must be lower, okay, than the left and the right shoulder. Inconsequential whether the left shoulder is going to be higher than the right or the right higher than the left. We don't care about that. We do care, but not as much. Okay, so again, break above the neckline, which is the neckline is the the connection of the two peaks or the two rebound levels. Okay, the higher price action has rebounded from. Okay, connection of the two creates the neckline. A break above the neckline, definitive break above the neckline, serves as a valid buy signal. Okay, so opposite case when it comes to this. Okay, So head and shoulders formation is one of the most well-known reversal patterns on the technical analysis chart when a price trend is in a process of a reversal, either from a bullish or a bearish trend. It's a characteristic pattern that takes the shape and is recognized as a reversal formation. We noted this. Inverted head and shoulders, completely the opposite. Inverted head and shoulders formation is the same as the name suggests, the opposite of head and shoulders. And it is too a reversal pattern, something else to keep in the back of your mind. On the technical analysis chart, when the price trend is in the process of reversal, either from a bullish or a bearish trend, characteristic pattern takes shape and is recognized as, once again, a reversal formation. Okay, so importance of the neckline, we have commented on this. Let's go on with a formal definition. So the drawn neckline of the pattern represents a support level. Whoop. Didn't want to erase this. Okay, so it acts as a support level. We're talking about obviously the normal or the traditional head and shoulders. This is obviously resistance, serves as resistance. This is support because you have price action bouncing from it. Okay, so and the assumption cannot be taken that the head and shoulder formation is completed, okay? Something else to pay attention to, unless the neckline is broken. So if this is not done and you get something like this, not a head and shoulders formation, you need to have a definitive break below the neckline, okay? And such breakthrough may happen to be on more volume than not. So you need volume bars being higher here compared to this, okay? Something else to keep on the back of your mind. Hence, a breakthrough should not be observed carelessly. A serious situation may occur. So if such a break is more than 3 to 4%, arbitrary number, but good enough, okay? 3 to 4% breakdown below this kind of level is what defines a nice valid neckline break or a valid signal for a short position. So when a price action drifts through the neckline on small volume, okay, we're talking about this area right here, there may be a wave up, although not certain, but it's sometimes observed. So the rally does not cross the general level of the neckline before selling pressure increases. The steep decline occurs and prices tumble with great volume. Okay, so pretty much self-explanatory. So characteristics, most of the times the head and shoulders are not perfectly shaped. We commented on this. The formation is therefore could be slightly tilted upward or downward. So if you compare the left shoulder with the right shoulder, you can have these kind of discrepancies most of the time. Now, never have I ever, personally speaking, here observed an equal kind of symmetrical head and shoulders. Maybe I have not seen many of them, that's why. But they definitely exist out there. Most of the ones I have seen, the two shoulders are not perfectly aligned. Some or one of the two is slanted either upwardly or downwardly. Nevertheless, you need to have the head above the two shoulders, definitely, then definitive break below the neckline in order for it to be a valid head and shoulders formation. Okay. Let's finish up with the characteristics. One shoulder may appear to drop, okay? On many chart patterns, any of the two shoulders may appear broader than the other two, which is caused by time involved in formation of the valleys and troughs, okay? Something else you can observe there. They're not going to be symmetrical in time as well, not only in price, but they may not be symmetrical in duration as well. No problem with that. Okay, this is definitely a variation. Neckline may not be perfectly horizontal, so sometimes you're gonna have slanted kind of necklines, either upwardly or downwardly, or maybe you can have a perfectly parallel one, okay, or a horizontal one, more specifically. If the neckline is ascending, then the only qualification of the formation lies in the fact that the lowest point of the right shoulder must be noticeably lower than the peak of the left shoulder. Okay, so usage as a tool, head and shoulders is an extremely useful tool after this confirmation. So it needs to be complete in order to be valid first before it needs to be assigned potency, okay, and measure the minimum profitable extent of the subsequent move from the neckline. Okay. In order to confirm, you need to, in a sense, calculate the difference between the neckline and the head, and you project that upwards. Okay. If the break is near that, then you'd have definite confirmation that price action is going to move to high ground in that kind of case, if it's an inverted head and shoulders. Okay. So to find the distance of the subsequent move, measure the distance from the peak of the head to the neckline, then measure the same distance down from the neckline on up if it's an inverted head and shoulders, to point where the prices penetrate the neckline after the completion of the right shoulder. Okay, this gives the minimum objective of how far prices can decline from the top after the completion. Okay, hopefully everything is here kind of clear. Okay. Next topic, moving on, reversal patterns. We also have what we call wedges. Okay. So wedge is in a sense identified by two converging trend lines that come together at an apex. What distinguishes the wedge is noticeable slant either to the upside or the downside. So you have not parallel lines. Okay. This is what we call a channel, more specifically an upwards moving channel. Wedge, the lines, this time, this line, this one, and this one, okay? They are slanted and they are, if you extend them further into the future, they are actually converging, and you might call this uh, converging triangle in a sense, okay? So you need to have them, if you extend them further into the future, they're gonna meet, okay? This is what we call the apex, by the way. This is the apex and this is the base, okay? The start or the creation of the ascending wedge or descending wedge. So this is the base, the distance between these two lines, okay? And this is the apex, the distance between these two now much more closer converging lines, okay? So this is the apex and this is the base. Just a few terminology you can come across, okay? So a rising wedge is considered bearish, okay, if it's found in an uptrend. If you see this on an uptrend, it is definitely a bearish signal, so a reversal may be imminent, whereas a falling wedge is considered to be bullish if this is found in an downtrend, okay? Much more potent if it's found in their original kind of habitat, if you would like. Okay. So wedge, what you need to take here from here is that it's like a symmetrical, it's like a channel, but the two lines are converging towards each other, much more closer to a triangle rather than a symmetrical channel, because obviously the lines in a channel are parallel. These lines of a wedge are converging. Okay. This is one of the characteristics of a wedge. So if it's found in an uptrend, it's considered to be a bearish signal. If it's found in a downtrend, if it's a descending wedge, is considered to be a bullish signal. Okay, so the wedge pattern is another commonly found pattern in the price charts of financial trading instruments. The pattern is characterized by contracting range in prices coupled with an upward trend in prices known as rising wedge, or in the flip side, a downward trend in prices known as a falling wedge. So this is what you see here. Lower, excuse me, sequentially lower highs. Okay, so at least the highs, they're higher highs, but they are not rallying much harder than they should be, if you like. At the contrary, you have higher lows. Okay, so you have this kind of area of congestion. Okay, as you progress through time and as you climb upwards. So the bulls are, in a sense, losing momentum. Okay, and the bears are eager to jump into the picture and drive the prices to lower ground. Hence, it's a bearish signal. Where on the opposite side, you have contracting kind of falls in regards to the bears' momentum. The bulls are eager to enter the picture. Okay. And once they do, and the price action congests near the apex, let me and made it worse. Near the apex of the descending wedge, this serves as a bullish signal. Okay, so a wedge pattern is considered to be a temporary hold of a primary trend. Okay, it's never a main trend. Okay, it's a hold in a major trend or a primary trend. So it's a type of formation in which trading activities are confined with a converging straight lines, which form a pattern. So this pattern has a rising or falling slant depending on the direction. So falling and rising wedges are small part of intermediate or a major trend. When we go over Elliott wave theory, you're going to have these kind of patterns emerging at specific points in the motive kind of waves over Elliott waves or on the corrective waves as well. So brace yourselves for this. It's going to come at near the end of the trading series, our webinar series. For the time being, let's move on. As they have reserved for minor trends, they are not considered to be major patterns, obviously. Now, once the basic or primary trend resumes itself, the wedge pattern loses its effectiveness as a technical indicator. So if they not break towards the downside and continue rising higher, obviously it's not a wedge. You shall not take that as a reversal signal. Therefore, extrapolating from this, you need to see a definitive break and a move, substantial move towards the opposite direction in order to be sure that the wedge is actually a valid one. Okay, no brainer there. Okay, so ascending or rising wedge. I think we have covered all of this, but let's quickly go over it. We're running out of time as well. So the rising wedge pattern is characterized by a chart pattern which forms when the market makes higher highs and higher lows with a contracting range, high highs, high lows, but as you can see, the range is contracting. So when the pattern is found in an uptrend, it's considered to be a reversal pattern, as the contraction of the range indicates that an uptrend is losing strength. This is how to interpret this kind of ascending wedge. Okay, so when this pattern is found in a downtrend, it's considered to be a bearish pattern, as the market range becomes narrower into a correction, indicating that correction is losing strength and that the resumption of the downtrend is in the making. So if an ascending wedge is found in a downtrend, it acts as a continuation pattern, not a reversal. Okay, so pay attention where you find ascending or descending wedges. So if an ascending wedge is found on the top, is a reversal signal. Okay, whereas if an ascending wedge is found on a downtrending kind of movement, okay, is considered to be a continuation pattern, not a reversal. Okay, because you need, in order for you to remember why that is, and when to see that on either an upside or a downtrend, kind of uptrend or a downtrend, you need to understand what this kind of formation means. Again, this means that the uptrend or the movement is losing momentum. Okay, the uptrend is losing momentum. So if it's found at the top, it's a reversal. If it's found on the bottom, that means the pullback, because this is going to be considered as a pullback if the price action is moving in this kind of fashion. Okay, this is running out of steam. This meaning all this I just circled is losing steam, and continuation will ensue. Okay, so in a rising wedge, both boundary lines slant up from left to the right, obviously. Although both lines point in the same direction, the lower the line rises at a steeper angle than the upper one. Okay, obviously, this is less than this. Okay, the slope of this is much slower than this. Okay, so prices usually decline after breaking through the lower boundary line by a definitive amount. Okay, so descending or falling wedge, completely the opposite. So let's go ahead. The descending wedge pattern is characterized by a chart pattern which forms when the market makes lower lows and lower highs with a contracting range. You can see that there. When the pattern is found in a downward trend, it's a reversal. Whereas if it's found in an uptrend, it's a bullish continuation pattern. Okay. So as the market becomes narrower into correction, that's indicates that the downward trend is losing strength and the resumption of the uptrend is in the making. Okay. So this is what we call a reversal. This descending wedge, because it's on a downtrend, signals, okay, a reversal. Whereas if that same thing was found in an uptrend, it's a continuation pattern. Okay, so you can see its dual nature. So you need first to identify where the market is moving towards to, then identify if you can spot correctly a descending wedge or an ascending wedge, and extrapolate from there onwards. First, you need to identify the major trend in order for you to make sense where it's going to move. Okay, and you need to see a complete and utter definitive break above it in order for you to be more sure that it is an actual descending wedge. Okay, and continuation or a reversal will take place depending on the movement of that specific market, the major kind of trend. Okay, I think it's enough about this. Let's move on to continuation patterns. We have flags and pennants, which represent brief pauses after dynamic market moves. Okay, this is their characteristic. This is definitely a dynamic market move. Okay, so they represent situations where a steep advance or decline. This is the decline, obviously, and this is a steep advance, has gotten ahead of itself and where the market pauses briefly to catch what we call its breath before running out again at the same direction. Okay, so this is what we call the three drive or flags and pennants. Okay, followed it can be found after you see an abrupt kind of sharp rise or fall of price action. You see the price action moving to the opposite kind of direction. Okay, power, brief, taking a breather, and then wow, is busting into higher territory with a lot of momentum and volume and price action. Okay, opposite opposite situation here. Okay, pennants are the other kind of type of a continuation pattern after a sharp rise in price or a sharp fall in price action. Once you see a contracting kind of range, what we call, in other words, a symmetrical triangle or a pennant. Okay, pennant is because it follows up a sharp movement. Okay, you expect to see a continuation of the price action to higher ground. Obviously, you need to see definitive break above it in order for you to get the confirmation that the price action is going to move to higher ground. Okay, but it serve the same purpose. They are continuation patterns. They are giving you the indication that the price action is taking a breather after a sharp move. The market has overextended itself. The market participants are now correcting, quote unquote, the price action. And at the end of the day, once you see the bulls and the buyers fight kind of giving in and moving closer to the apex, the bulls once again take the direction, the initiative, and push the price action to high ground. And in this case, the bears do so as well. Okay. So this is the verbal kind of description, written in word for illustrated for you to look at. So the flag pattern is encompassed by two parallel lines. So this is what we call a channel or the three drives. Okay, kind of move. These lines can be either flat or pointed to the opposite direction of the primary trend. This moves upwards, this moves up, excuse me, this moves downwards, this moves upwards, opposite direction. Okay, the pole, this is the pole, this sharp, abrupt move, okay, is then formed by a line which represents the primary trend in the market. Now, the pattern is seen as the market potentially just taking a breather after a big move and continuing its primary trend. Okay, discuss this. So pennant pattern, again, discuss this as well. The pennant pattern is identical to the flag pattern in its setup and implications, but the only difference is that consolidation phase of a pennant pattern is characterized by a converging trend lines rather than parallel. Okay, so flags have parallel lines, whereas pennants have converging lines. Okay, not as nice, but you get the point. Same as another continuation pattern. Okay, so this brings us to the end of today's session, guys. Thanks for watching, and we'll catch you on to next session where we're gonna probably discuss, if I'm not mistaken, about we're gonna go back to fundamental analysis, and we're gonna cover the most widely known economic indicators that fundamental analysts look at for them to gauge how a specific country's economy or a specific instrument is behaving and how it will be affected by incoming data, and use that kind of information to make much more sophisticated kind of predictions, or actually go ahead and capitalize upon that kind of information and strategically trade them. Okay, so for the time being, thanks for watching. We'll catch you on to next week's webinar for another lovely episode of our series. For the time being, thanks for watching, guys. Ciao, ciao. Bye bye.